Welcome to The Explainer. Today, we are going to break down a really big deal. A multi-billion-dollar merger that's literally creating a new giant in the offshore drilling industry. We're looking at Transocean's plan to acquire Valaris, all based on a recent piece from the Wall Street Journal.
All right, so here's our game plan. First, we'll cover the big news itself. Then, we'll introduce you to the companies involved. After that, we're going to unpack how this deal actually works and dig into why they're doing this right now. We'll also take a look at how the market reacted. And, to wrap it all up, we'll give you 3 key takeaways. Sound good? Let's jump in.
All right, so let's get right to it. First up, a new drilling giant. What exactly just went down in the world of offshore drilling?
So here's the headline. Transocean is buying Valaris. And this isn't just some small acquisition. We're talking about one of the biggest offshore drilling companies out there buying another major competitor.
And get this, the price tag is a whopping $5.8 billion. A deal of this magnitude, well, it's a huge signal that the entire industry is shifting.
Okay, so who are these two companies? Let's meet the key players, Transocean and Valaris.
This isn't a situation where a tech company is buying a coffee shop. Nope. Both Transocean and Valaris are absolute heavyweights in the exact same business, offshore drilling services. Basically, they're the ones with those massive, super complex rigs that drill for oil and gas way out in the deep ocean.
And once they team up, they're going to have a combined fleet of 73 rigs. That's a huge number, and it makes them a much more powerful force on the global stage.
So how do you even pull off a deal worth billions of dollars? Let's break down the mechanics of how this thing actually works.
Okay, so the article points out that this is an all-stock deal. So what's that? Well, think of it this way. Instead of paying for Valaris with a huge pile of cash, Transocean is basically paying with pieces of its own company. It's giving Valaris shareholders stock in the new, bigger company.
And check out how the new company will be owned. It's almost an even split. After everything's said and done, Transocean's original shareholders will have 53%, but Valaris' shareholders, they get a really big piece of the pie at 47%. So this feels less like a simple takeover and more like a true merger of equals.
Now, there's another key term the article brings up, enterprise value. This is really important. It's a way to look at a company's total worth, not just its stock price. It also includes all of its debt, so you get a much fuller picture of what the company is actually valued at.
And that brings us to this number, which just shows you the incredible scale we're talking about. The combined enterprise value of this new drilling behemoth is estimated to be $17 billion. Just massive. Okay, so this all begs a pretty big question, right? With so much money on the line, why this merger? And why now? Let's look at the strategy.
So what is the strategy behind this whole thing? Well, you can bet the timing isn't random. A move this big points to a very clear goal they have in mind.
And a huge piece of the puzzle is a term you're gonna hear a lot, an offshore drilling upcycle. Now, that might sound complicated, but it's pretty simple. It just means a long period of time where business is expected to grow a lot, with way more demand for drilling services.
And hey, we don't even have to guess what they're thinking. The CEO of Transocean, Keelan Adamson, said it flat out. He said, the powerful combination is well-timed to capitalize on an emerging multi-year offshore drilling upcycle. In other words, they think a boom is coming, and this deal gets them ready for it.
So, when you boil it all down, the goals are pretty clear. Number 1, expand their reach into the best drilling spots around the world. Number 2, get ready to ride that wave of the coming market boom. And number 3, save a ton of money by being more efficient.
And that's not just pocket change we're talking about. The savings are expected to be over $200 million per year. That's what they're hoping to get just by combining their operations.
So that's the game plan. But what did the market think? How did investors on Wall Street react when they heard the news?
Well, the immediate reaction was pretty interesting, and it's actually kind of typical for these big deals. Valaris' stock, that's the company being bought, it shot up 22%. Investors loved it. But Transocean stock, the buyer, it actually dipped just a little. That's pretty common, because investors are thinking about the huge costs of the deal.
Okay, we've covered a lot of ground. So let's wrap this up with the 3 key takeaways. What are the most important things to remember from all this?
All right, here we go. Takeaway number 1, a new giant is born. This deal creates an absolute powerhouse in the world of offshore drilling. Takeaway number 2, it's a huge bet on the future. The whole merger is a strategic play to cash in on an expected industry boom. And takeaway number 3, The market's reaction was mixed. Investors were thrilled for Valaris, but a little more cautious about Transocean, which just goes to show how complex these megadeals can be.
So at the end of the day, this deal is about more than just two companies. It's reshaping an entire global industry. And that leaves us with one big question to think about. As these two giants join forces to chase a boom in drilling, what does this massive consolidation really mean for the future of our global energy supply?